That was the JSW Steel management. Joining us now is Parag Thakkar, who is the senior fund manager at Fort Capital. Parag, what's your take on the JSW JFE deal?
No, it's a clear win-win because on one hand, as Mr. Jayant Acharya was saying, JSW Steel will be reducing its debt by 37,250 crore. Now, as on September 25, they had a debt of around 79,500 crore. So it deleverages the balance sheet significantly. It creates a further space to get leverage and to accelerate their growth plans. As they said, 51 million tons by 2031, and they can actually fasten up that. Plus, they can get ready for Orissa expansion, Varadip expansion. So I think it helps them to make their balance sheet leaner, cleaner, to reduce net debt to EBITDA to say 1.7x on FY27 EBITDA. So they can take that journey forward. Plus, in Bhushan's power also, the capacity will be expanded to 10 million tons with the help of JFE. And with JFE being technologically superior, far more superior globally, they'll be able to make a value-added steel over there. So there also the margins will expand. So structurally, EBITDA per ton will also improve. Plus, the other thing which is helping steel companies or any metal company, when rupee depreciates, your import parity price cost improves, goes up, which also gives protection to you. In a way, it acts like a safeguard duty. So I would like to say that things are very positive for JSW Steel. Of course, right now on ground, as we see, the steel demand has not yet picked up and steel prices are depressed. That is why steel stocks were not doing well. But this deal, I would say, is a game changer in a right direction. And most importantly, for an aggressive growth company like JSW Steel, it is a very good step to reduce debt and then move forward.
Parag, if you look at the steel cycle, as you yourself said, prices are soft, and they have lined up a heavy cap plan over the next 3 to 5 years, means 34 million tons to 50 million tons by 2030. Do you think that that would be prudent to do that at this point in time when the steel cycle is at it's going sideways?
No, no. So basically, when promoters look at all these things, they look at it from long-term perspective. We as investors always tend to see that what is happening on the ground today because it's a recency impact. But the fact of the matter is steel industry is very consolidated. Only 4 or 5 players are able to expand capacities. And definitely with India's growth at above 7% GDP growth, we will require more steel. Last 4 months have been weaker because prolonged monsoon was there. And I would say that now that we are seeing good pickup in auto, we definitely, and some infrastructure capex, housing also coming back next year. In my view, from JSW Steel's perspective, I don't feel that they'll not be able to sell their steel. They are, and remember, JSW Steel is one of the lowest cost producer of the steel, and in terms of conversion, if you knock out the iron ore benefit which Tata Steel and SAIL has, they are the lowest cost converters. Plus, they put up the plants at lowest capex per ton, so their ROCs are better. So I would like to say that this is a great step from JSW Steel, and I am very happy personally to see that they are conscious that they are reducing debt before moving ahead in a big way for further expansion.
Okay.